Welcome back, everybody. So, on today's lesson, I'm going to be talking about stop loss placement. Now, a lot of traders find this very difficult when really, in actual fact, it's not. In determining your stop loss, it really varies on the type of person you are, the character that you have, and the time that you have to actually trade. Now, what you have to really understand is that this business, in terms of forex and trading, is all to do with numbers. Now, the attributes that you need in terms of being disciplined, in control of your emotions, being able to control your psychology, etc., is all true, but realistically, unless you're taking the trades and allowing the numbers games to play out for you, then all of that's not going to really work. So, in any event, regardless of where you place your stop loss, whether it be in a good position or whether it be in a bad position, you are going to still lose trades and you're still going to win trades. So, how can we determine which stop loss strategy is going to work for you? So what we're going to do today is we're going to go over 4 strategies that you can implement yourself. Not all of them are going to be for you, maybe 1 or 2, but you can make that decision and you can go from here. And I really hope this helps because this helped me in the beginning when I started trading, and then I decided to fix onto one that I found that worked best for me, my personality, my character, and obviously from where I was coming from in terms of my lifestyle. So the first one we're going to look at is the set and forget. Now, you all probably have heard about this, and most traders say just set your trade, let it play out, and whatever else. Well, I agree with that to a certain extent, but I think that the set and forget strategy personally is more for those that are not in control of their emotions. Because a lot of traders think to themselves, well, do you know what? If I place a trade and I stare at the charts long enough, then I'll be able to help control the candles move in the direction that I want, and I'll be able to telepathically tell the candles to go down. And if I start to draw levels in the market, then it's going to start to respect it. I mean, I've been there and done it, so it's all funny, but we know it doesn't work. So, what is a set and forget strategy and why is it good? Well, to be honest with you, it just allows you to enter the market, allow for the trade to play out, and remove you and your emotions from staring at those charts. And why does it work? Well, the truth is, most emotional traders have a tendency to revenge trade, or they like to think that they can move their stop loss and they'll be able to stay in position, or they think to themselves, if I add to this position, then I can get some of my losses back, or I can make more money. And setting and forgetting really removes that temptation. So, what do you do in a set and forget situation? Well, you remove emotions. Simple as that. It means you can't control anything and you let the charts play out. So let's take a look at this scenario here. We see that the market is pushing to the downside. We have this pullback. Now we have this level in the market where prices created wick rejections for at least a good 2 hours. Price left that level, came back, and now we can see a nice double top. Now for about 2 hours, price didn't move. We saw a lot of indecision, and then we saw an impulse of bearish pressure to the downside. So let's take this trade. We see a nice bearish engulfing candle. We set our trade, stop loss above structure, and then go for your targets. I always personally like to go for 1 to 3, so that's what I'm going to be doing in this situation. So we have a 1 to 3 risk to reward ratio trade, give or take here or there. Now, what are we going to do? Well, we're simply just going to let this trade play out. Now, we do want a notification what's happening with this trade, whether it hits stop loss or whether it hits take profit. So what can we do? Well, you can simply just set an alert at your stop loss, and you can simply set an alert at your take profit. Now, this will stop you wondering what's happening to your chart, because if it does hit your stop loss, then you're going to know about it, And if it is your take profit, then you're going to know about it. And you might say to me, well, why would you set an alert if you want to set and forget and not be controlled emotionally? Well, the truth is, sometimes you might be sitting in drawdown for 3 or 4 hours, and you're probably going to be thinking to yourself, well, hold on, what's happening with this trade? And if you haven't set an alert, then guess what? You're never going to know whether prices hit your stop loss, and before you know it, you could just get confused and start making up too many scenarios that forces you to come back to your charts to do dumb things. So set an alert will reassure you and confirm whether you either hit take profit or stop loss, or whether you're still in that position or not. So let's run it out. We set this trade, we've walked away now, we've closed our laptop, closed down that MT4, and we now just let this trade play out. Now, the reason why this is good is because once the market starts to move in your direction, you have to think about this. These are hourly candles. It's not always going to continue to push to the downside. There are going to be times where the market moves sideways, in this instance, for 2 hours. Then the market might continue to move sideways, in this instance, for quite a few more hours. Now, imagine if you're staring at your charts and you're seeing this. Psychologically, it's really going to mess you up. So the best thing to do is let it run. If you have a strategy that works, you know that it's proven because you've back tested it, you forward tested it, and you've got the data to prove that, then technically, again, we fall back to the numbers game. So in this instance, as you can see, we've hit take profit on this, and what's that? Bob's your uncle. Now, they're not all going to hit take profit. You are going to obviously lose some of them, but in an instance like this, we hit take profit. And I think personally, for those that are more not in tune with their emotions, this is the best strategy to go for. So I hope that was helpful. So in our second example, we're going to use a strategy called the trailing stop. Now, most people will see the trailing stop differently, but the strategy that I'm going to show now is really for those that are in control of their emotions. Now, these type of traders, they're happy to take small profits on a regular basis by managing their trades very aggressively. Now, what does this allow them to do? Well, it allows them to take advantage of tight entries so that they can increase their odds of gain, which means they can go in with a slightly bigger lot size. If they lose, they're still only losing a small percentage or a percentage of their account size, but they're also allowing room for when the market moves in the direction to really take advantage of big profits. Now, with this strategy, it's not for the faint-hearted. There are times where you are going to be stopped out on a regular basis, and whilst you're breaking down your actual entry with your position size, you may be stopped out maybe on 1, 2, or 3 occasions before the market moves in your direction. If not, you then will just take a small percentage loss on your account and you move on. But what are the advantages? Well, the thing is, if the market does start to move in your direction, which is going to be based on your strategy, you should have back tested this and forward tested this, then when the market does move, you're going to be able to trail your stop loss. You're going to be able to take advantage of the momentum at that specific time, and the gains that you're going to be getting from this are going to be quite big. So in this example, we're only going to use the hourly time frame, and I'm not going to go into tight entries, etc., etc. But what I will identify here is how we can take these trading stop loss trades. So we can clearly see the market structure is to the downside. Now, we do have this pullback lower high. We did have an area in the market where price broke above to make this higher high, but as you can see in recent price action, price did break and close below the structure, indicating continued bearish pressure in the market. And now we have an area here where price is stalling out. So for that reason, we have a nice pin bar to the downside, indicating bearish pressure, and we're going to take this trade with all the evidence that we've gathered, and we're going to see what happens. So are we going for a risk reward ratio? Well, no, we're not. We're just going to simply be going for a 1-to-1 risk reward ratio to make sure that we can lock this trade in at break even, and then once we're at break even, the rest will manage as we go along. So the market starts to move in our direction, and now what do? Well, we want to lock this trade in break even, but how do we continue to trail this in so that we can start to take profits as the market's moving down? Well, what you're going to simply do is you're going to place your stop loss above the previous candle's high. Now, what you will find is if the market is in momentum, very rarely will you see price peak above the last candle's high. It may pull back to 50%, it may pull back close to the wick, but more often than not it won't. So that's how we're going to take advantage of taking big profits from the market with minimal risk. As I said, it's not for the faint-hearted, it's more for those that are in control of their emotions and are happy to take small profits along the way. So as you can see, the markets continue to push down, so we're going to trail our stop loss above this structure. Each time we're just moving the stop loss above the wick high. As I said, more often than not, if the market is in momentum, you will find that price will never come back to the previous structure high of the last candle, especially on the 4H, 1H time frames. So let's continue with this. Now, as you can see, we've taken quite a bit out of the market now. We've taken this whole position. Now, not all of them are going to win, by the way. Just remember this. So I don't want to make this up and make you think that this is the Holy Grail, but this is just an illustration of how you can do it. So you can continue to trail your stop as the market goes down. Each time you're trailing your stop, you're securing profits. So if the market does come back and turn against you and hit your stop loss, then guess what? You'll be able to take some profit. So we survived there, and we'll continue, and there we go. That's where we're stopped out. So for this position, we was able to extract quite a bit from the market. In fact, about stop loss above structure. Let's check this now. Stop loss above structure. We was able to extract a good 4.5 R from this position, so it's huge. Now this is great, as I said, if you really want to get in the markets to extract as much as you can and only take advantage of big moves when the market's in momentum. If the market's not, then you will find that you will be stopped out, especially if it's ranging or not moving in the direction you want it to go. But this strategy itself is amazing, and I think those that are more in control of their emotions, go for it, because this is where some of the biggest profits are going to come from. Remember, it's not about trying to make money every single trade that you take. It's more about risk management and then capitalizing when those trades come along. So the next strategy we're going to look at is a fixed stop loss strategy. Now this is more for those that are disciplined and systematic, those that really want to play the numbers game and are happy to take 100 trades and then evaluate their percent gain at the end of the 100 trades. Now there's no time for what ifs for these traders. It's just literally get into the market, manage my trade according to my plan, not to deviate, just to continue to be disciplined and patient and just play the numbers game. So how does this work? Well, we're going to give you an example here. We can see price action is stalling out around this level. We're coming off a strong bullish pressure to the upside. Price has attempted to break the structure on many occasions, and for the last 3 hours it attempted to break up, failed, and we've pushed back down. So what are we going to do in this situation? We're going to take the trade, and how are we going to manage this trade? Well, as I said, we're going to use a fixed risk to reward ratio here, and we're going to use a fixed stop loss strategy. So we're going to take a 22 pip stop loss, and we're going to take a 66 pip target on this, so that's a 1 to 3. And how are we going to manage this? Well, what we're going to do is when price gets to around, so this is a 22 pip, just got lost there for a second. So when price gets to here, we're going to lock this trade in at break even. When price gets to in and around here, another 22 pips, we're going to lock this trade in at 50% profits. And then when the market gets down to here, we're going to close a position. So this can be varied in any which way you want, but the strategy is just going to be the simple. When price gets to 1R, which is the same size as our stop loss, we're going to go break even. When price gets to 2R, we're going to take off profits, which is about 50% in this instance. And then when price gets to our take profit, we're at take profit. So let's see what happens. So the market moves in our direction. There is no question about what we're doing now. We have a fixed stop loss strategy, which means the rules are we go to break even. The minute price pushes down to our level here, we are taking off 50% profits. Now what we can do is we're not going to be trading this, but we can lock this in at profits. So we're already taking off 50%, and if the market moves back, we're not going to lose anything in terms of commissions or spreads. We're going to be taken out in slight profits. And then for the rest of the position, it's just a matter of waiting to see whether the market continues in our direction or whether we get taken out break even. And in this instance, as you can see, we've hit take profit. So it's pretty simple. Now, why does this work? Well, again, if you have a strategy that plays out 50-60% of the time, then over 100 trades, you know you're going to be profitable. You're going to be using this strategy as a no-nonsense strategy approach, which means you're not going to be risking your profits. You're not going to be risking any of your money that you put in on the line. The minute price moves in your direction, you're locking that in break even, and the market's either going to go in your direction or it's not. When price gets to 2R, you're making sure that you're taking 50% off so you can secure some profits over these trades, just in case the market does go against you. And what you will find over a period of time, if you do take profits off at around, let's say 2R, 50%, and you find that the market is not going in your direction for whatever reason, then guess what? Those small profits that you're taking off do add up. They continue to add to your account size so that you can continue to increase your risk percent, which means that your gain is going to increase also. So the final example that we're going to look at is a structural based stop loss strategy. Now, who is this for? Well, really and truly, it's for patient traders. This could be for somebody that's working a 9 to 5.